bonds. You've probably heard the word bond. Bond is one of the most important investments in the market that you generally ignore. Now, bonds are generally long-term investments that last anywhere from about 1 month to 30 years. They are generally considered safe investments. Now, generally, the people who sell bonds are either corporations or the government, and they usually sell these bonds because they need money. This money that they receive generally gets converted to debt on the other side. And as we all know, corporations and governments love money. Now, the typical investor, including you and I, we ignore bonds. Bonds are generally considered a very boring investment, and they don't run up 100% within a trading day. Now, who buys these bonds? Generally, financial institutions. These financial institutions buy these bonds for the fixed return that it gives over the duration of the bond. And this is what makes bonds one of the most important investments in the entire market, mainly because all of the quote-unquote smart money invests in these things. Now, I could sit here and give you a long quantitative explanation and all of the equations associated with that I actually don't know about how these prices are priced. But let's be real here, I suck at this, and I just work here. To give you the simplest version of it, bonds are sold at a fixed price. When bonds go up, yields go down. When bonds go down, yields go up. One of the largest purchaser of bonds were banks. Banks ate that shit up really quickly. In fact, the banks were told by the government itself to buy these bonds, and in return, the government would not increase interest rates. Prices are tied to interest rates, generally being hedged for the yields that these bonds give. Now, even though that the government said that they would not increase interest rates, as we all know, they did. And not only did they increase them at the quickest rate ever seen in history. And this is exactly what the banks did. They bought the crap out of these bonds, spending billions, if not trillions of dollars doing so. The banks picked up all of their math Olympians and plugged in some numbers into some algorithms and started to slowly realize that they were about to lose a crap ton of money. And when I say a crap ton of money, I mean a crap ton of money. Enough money to the point that they were going to get screwed. Screwed to the left, screwed to the right, screwed from up, down, side to side, any way you want it. I mean, at this point, they need new fallopian tubes. It's bad. The person you're currently looking at is the CEO of Charles Schwab. And the face you see him making in this picture highlights the exact feeling every single bank in the United States and potentially across the globe is currently feeling. You may be saying to yourself, Flo, who cares? Who cares if banks lose all this money? Didn't they screw us over back in 2008? One simple question for you. Whose money did the banks use to buy all these bonds? That's right, yours, baby. So this should be the moment where you start to slowly realize that you are now screwed. As well as the fact that as bond yields rise, stocks go down, other assets go down, including gold, silver. I mean, it's just the whole shebang. I mean, it's absolute chaos out there. Now, they won't tell you this. They won't report it to you, whatever. It doesn't matter, right? It doesn't matter to them to tell you. But I'm here to tell you that this picture right here, this little meme that you see on the screen, this is the entire system right now.